Well, good morning once again, options traders. Well, for anyone who's had coaching calls with me knows that I rarely use stop orders on options. And there's a very good reason for that, and I do have videos on here explaining why. But what about for the stock traders and ETF traders? Well, you have to be careful with stops as well. There are a lot of myths and misperceptions regarding stops and how they work and how they don't work. And if you're making your decisions based on misperceptions, they become dangers. So when so many other people and traders tell you to use stops and they'll say that they're a necessity for success, why am I telling you that there are some dangers? Well, let's take a look at 5 of the key dangers of stop orders. The first problem is that when it comes to stock prices, there is no predictive power. Knowing today's price or where it's been in the past is not going to help you of where it's going to be in the future. Now, yeah, we can use technical analysis to try to gauge where it might be in the next few days, assist with timing for buys and sells. But it's not really going to tell you what's going to happen. And that's why you're going to see all of the caveats. According to the SEC, you got to say that past performance is no guarantee of future results. And there's a very good reason for that. So the problem is that if you're using stops and you get stopped out, is the stock price more likely to continue lower? See, it's more of a psychological crutch that people go, we've got this fear of taking losses and we see it going down. It just feels better to get out of it. But is there really any mathematical merit to that? That now the stock is somehow has a better chance of going lower? Well, if that were true, why do we just get out of the position? Why not short the stock? If it's giving you that good of information of saying that, yes, it's much higher probability that's going to continue lower, why not short it? See, the traders don't tell you to do that. They say, just get stopped out. And that really would make no sense. That's just limiting a loss. Why not use it as a way to make gains? And if that works on the way down, why not on the way up? Why not only buy stocks that have had tremendous gains? So you probably don't do that. But yet it would certainly make the same logical sense if a stock has had tremendous gains, that therefore it's more likely to continue higher. And yet people usually get fearful of that, but they do the opposite when stocks are falling. And so because there's really no predictive powers, you're just as likely to get stopped out at the wrong time as the right time. So this gets back to what I've talked about before with randomness, and people just have very bad misperceptions of how stock prices truly work. So here's an example to think about. Let's flip a coin 250 times. How likely is it to get 10 heads in a row or 10 tails? If you ask most people, they're going to think, oh, that would hardly ever happen. Well, let's jump over to an Excel spreadsheet and take a look. So here's a little Excel spreadsheet that I put together, and in this column, this first column right here, are just coin flips. You can see heads and tails, and we have 250 rows. So that's roughly the number of trading days in a year. And then what this column does is it just counts how many we have in a row. So this number 2 right there is showing that we got 2 heads in a row, and then we switched to a tail. We got 2 tails in a row, so we got a 2. So look at this. We got 12 in a row. Somewhere along the way, let's find out where it was. And so there it is, there's 12. There are the 12 in a row. So it seems like it might be highly unlikely, and yet it's not all that unlikely. So let's try it again. Maybe that was just a fluke. Let's hit F9 and recalc. Somewhere in this spreadsheet, we got 7 in a row. Let's try it again. There's 9 in a row. Try it again. There's 8. There's 6. There's 10. 8. 15 in a row. Let's find this one. Where's our number 15 in here? No, let's see. Right down there. So there's 15 in a row. See, another thing that people overlook is that you might say, well, it might be sort of possible to get 8 or 9, but once you've gotten that, it's now a 50-50 shot that you're going to go to 10. And once you've gotten that, it's a 50-50 shot you're going to go to 11. So it's not really all that unlikely to get these very long streaks by nothing but pure chance. And that's what happens with stock prices. And unfortunately, when people get in their stock at 100 and it pulls back to 95, they panic and say, oh, it must be heading down. There's no way a stock could go 5 points, in a short time, or several days of straight down days. I'd better get out. and it's nothing but chance at work. So just remember that whenever you're using those stops and you think that you're seeing a pattern that's giving you some information, it's probably just noise. So now that you understand those points, let's look at another example. Let's say that we buy shares of stock at 50 and it runs up to 100, and then over a short time it pulls back to 95. Again, is it more likely to fall? I mean, you'd have to say if it started at 50, we went up to 100. Yes, we had lots of zigs and zags, lots of ups and downs along the way, but it's been a remarkable performance. So if we bought the stock at 50 and it's trading for 95, we'd probably say, no, hang on to it. But now let's change the perspective. What if somebody else just bought at 100 and then they see it fall to 95? See, they're going to think it's a good deal to get out at 95, whereas another trader is going to think it's a great deal to stay in. See, the problem is what you should be doing is assessing 95 or whatever the current stock price is on its own merits. Would you like to be a buyer at 95? And if the answer is yes, stay in it, even though you might have paid 100. Remember, the stock doesn't know what you paid for it. So remember, just because you bought stock at 100 doesn't mean it's a good idea to get stopped out just because it's fallen to 95. All right, let's look at danger number 2, and that is volatility. Understand that volatility is symmetrical, and that means that higher volatility means a greater range of stock prices, higher and lower. Too many times traders think that volatility is only associated with downside and falling stock prices and like coronavirus, and they say, oh, that's high volatility. Not necessarily true. We can get high volatility to the upside as well. But the point to understand is that you can't get the higher returns if you're reducing risk. And that's what you're doing when you're using stops. You are cutting the volatility. Now, if you could do that, if you could get higher returns by chopping off the risk and selling when stock prices go down, stop orders would cost money. They would have some real value. That means that everybody can be made better off and that you've got some kind of a statistical edge by getting stopped out. Brokers wouldn't be giving that stuff away for free. They don't give put options away for free, right? People don't sell those for free because they have some real value. You would get the same thing out of stop orders. So just remember that there's no real special magic to a stop order. In most cases, it's just a psychological crutch. So here's what our bell curve looks like. Let's say a certain volatility. If volatility increases, that bell curve is going to get shorter and wider. And what that's telling you is that you just have more potential prices. See how this red area here on this red curve sticks out past the blue? To the upside and the downside, not just the downside. So if you're using stops, what you're trying to do is to chop off all of this potential risk, but still hang on to this. And see, that just can't happen. If you're going to get stopped out here, you absolutely are cutting off this side of the bell curve. So the problem that most people tell you about stop orders is they say, oh, you've got to put your stops in so you limit the losses, but then you get the big gains. Just simply cannot work. If you're limiting the losses, you absolutely must be limiting the gains. All right, number 3, what I call the buy it back fallacy. Traders like to use stops because they'll say they'll buy it back once it reverses. Well, yeah, I bought that stock at 100, it's trading at 95. Let me just wait until it gets back on track and then I'll get back in. Well, hold on a second. If your timing was that good, they wouldn't have sustained the first loss. What makes you think that just because you get stopped out, that now your timing suddenly becomes exponentially better? All right, so does getting stopped out increase your chances of now picking the right time? It has no bearing on it whatsoever. So don't use stops on the false belief that it's going to give you a better chance to buy back in at a better time. Risk number 4, which level? Which stop level should you use? 5%, 10%, 20%, $3, $7? There's all kinds of different ways to pick stops. And this is why so many traders have questions about this. What's the right level for a stop order? Well, there isn't one. The problem is that some levels might be perfect. Looking in hindsight, we could tell you exactly which one would be perfect. But today we don't know. And that's why it's such a hard question. So the right level really comes down to a coin flip. It might be right and it might be wrong. And so the problem is that coin flips are just simply not a good strategy. And then finally, risk number 5, move on to another. You hear this a lot from traders, but if you get stopped out and pick a new stock, is it going to be better? What makes you think that that's going to be any safer than the one that you left? What if it falls? What if the previous one, the one that you sold, now rises? See, those are the problems, is that people think that just because they get stopped out, that they now have a better chance of moving on to something else, and that they've limited those losses. All you've done is you've changed the risk-reward profiles, you've chopped off the lower volatility, which means you've given up the higher volatility, and you really haven't done anything for improving your chances for success. How do you do that? By hedging your positions, and for that, you need to know options. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.